Hi everyone, and welcome to the CLiK Trading Education Weekly Market Update for the week ending the 13th of March 2026. Each week we break down what actually moved the markets, what the key drivers were behind those moves, and more importantly, what traders should be watching in the week ahead. As always, this isn't about predicting markets perfectly. It's about understanding the environment we're trading in and approaching the markets with a structured plan and disciplined risk management. So let's take a look at what happened this week. Markets delivered a mixed but very instructive week. Equities struggled to maintain their upside momentum. Cryptocurrencies rallied strongly. Volatility eased slightly from recent highs, and the US dollar strengthened against several major currencies. The key takeaway this week is that markets are transitioning from broad momentum-driven moves to a more selective environment driven by macro data and institutional positioning. In simple terms, markets are becoming more selective. This means traders need to focus less on chasing broad trends and more on identifying specific opportunities where institutional money is flowing. Let's start with a quick look at the major market performance for the week. The S&P 500 declined around 0.9%, while the Nasdaq slipped slightly by about 0.4%. The Russell 2000 also weakened slightly, suggesting some cooling in risk appetite. Interestingly, the Dow Jones performed strongly this week, rising nearly 5%. In commodities, gold and silver pulled back, with gold down around 3%. And silver down roughly 4.7%. Meanwhile, cryptocurrencies continued their strong momentum, with Bitcoin up over 6% and Solana leading the gains with more than 14% for the week. Volatility also eased, with the VIX falling sharply from around 35 to 27. This combination tells us something important. Markets are stabilizing, but uncertainty remains elevated. Looking specifically at equity markets, we saw mixed performance across major technology stocks. Apple and Microsoft both declined during the week, while Alphabet and Nvidia managed to post gains. Meta and Palantir also weakened slightly. This type of mixed performance often signals institutional sector rotation rather than a broad risk-off move. In other words, capital isn't necessarily leaving the markets, it's simply moving between sectors. For traders, this is important because it often creates opportunities in specific stocks or sectors rather than broad index trends. The VIX Volatility Index fell significantly this week. It dropped from around 35 to 27, which suggests that panic levels have eased following recent volatility spikes. However, volatility is still elevated compared with long-term averages. In environments like this, traders need to focus on three key principles. First, disciplined position sizing. Second, clearly defined stop losses. And third, patience, waiting for structured setups rather than forcing trades. High volatility environments can create opportunity, but they also punish poor risk management. Cryptocurrency markets continued to show strong momentum this week. Bitcoin rose roughly 6.5%, Ethereum gained around 8%, and Solana delivered the strongest move with more than a 14% gain. The rally appears to be supported by continued institutional adoption, ETF inflows, and sustained retail participation. However, crypto markets are highly momentum-driven. One of the most common mistakes traders make in these markets is chasing extended moves after large rallies. Professional traders typically wait for pullbacks or confirmation before entering positions. In commodities, precious metals experienced a notable correction. Gold fell about 3% and silver declined nearly 5%. This appears to be largely profit-taking after strong gains earlier in the year rather than a structural change in the market. Crude oil remained extremely volatile. During the week, it traded in a very wide range between roughly $76 and $119 before closing near $99. Energy markets continue to react to geopolitical tensions, supply concerns, and global economic expectations. In currency markets, the US dollar strengthened moderately across several major pairs. Euro declined just over 1%, while the pound fell around 0.9%. The Swissy and CAD both moved higher. Dollar strength continues to reflect global capital flows, interest rate expectations, and safe haven demand. Whenever uncertainty rises in global markets, the US dollar tends to attract capital. One of the most important drivers of markets right now is interest rate expectations. Markets continue debating how quickly central banks may begin easing policy. Higher interest rates for longer tend to strengthen the US dollar, reduce liquidity in risk assets, and pressure growth stocks. This is why central bank communication remains one of the most powerful forces in financial markets. Geopolitical developments also continue to influence markets. Investors are closely monitoring developments in the Middle East, global energy supply chains, and strategic competition between major global economies. These factors tend to drive safe haven flows into assets such as gold, US treasuries, and the US dollar. Understanding these relationships is a key part of intermarket analysis. Another important theme this week was institutional positioning. The market showed clear signs of sector rotation rather than broad liquidation. Capital continues shifting between asset classes and sectors. For traders, identifying where institutional money is flowing can often provide valuable clues about where the next opportunities may appear. Looking ahead to next week, the economic calendar is extremely important. We have a cluster of major central bank announcements within the same week. These include decisions from the Federal Reserve, the Bank of England, the Swiss National Bank, the Bank of Japan, and the Bank of Canada. Whenever multiple central banks announce policy decisions within the same week, currency markets in particular can become significantly more volatile. On Monday, we begin with important data from China, including industrial production and retail sales. These figures are important for commodities and currencies like the Australian dollar because they provide insight into global demand. Later in the day, we also have US retail sales, one of the most important indicators of consumer spending. Given that consumer spending drives a large portion of the US economy, this release can move equity markets, the US dollar, and treasury yields. The most important event of the week will be the Federal Reserve interest rate decision on Wednesday. The rate announcement comes at 6 p.m. UK time, followed by the press conference at 6:30 p.m. Markets will be analysing the Fed's outlook for inflation, interest rates, and economic growth. Fed communication frequently drives large moves across equities, currencies, and commodities. Thursday is effectively a central bank super day. We have policy decisions expected from the Swiss National Bank, the Bank of England, the Bank of Japan, and the Bank of Canada. This clustering of central bank announcements can create significant volatility in foreign exchange markets. Traders should be particularly cautious around these events. Finally, the week concludes with the US University of Michigan Consumer Sentiment Report. This survey measures consumer confidence and expectations around economic conditions. It often provides a useful signal about consumer behavior and economic outlook. Heading into next week, several markets remain particularly interesting. The S&P 500 is approaching important support levels following its recent pullback. The US dollar index remains strong after closing the week near its highs. Gold has corrected and could provide opportunities if safe haven demand returns. And Bitcoin continues to show strong momentum, but may be approaching areas where profit taking could appear. This week's trading lesson is simple but important. Markets rarely move in straight lines. They rotate between trend phases, consolidation phases, and rotation phases. Successful traders don't chase every move. Instead, they focus on managing risk, executing their trading plan, and waiting patiently for high probability setups. To summarize the current environment, central bank expectations continue to drive global markets. Geopolitical uncertainty remains elevated. Equity markets are showing sector rotation rather than broad weakness, and cryptocurrencies continue to show strong momentum. This combination creates opportunities, but only for traders who remain disciplined and patient. That brings us to the end of this week's market update. Remember, successful trading isn't about predicting every move in the market. It's about understanding the environment, managing risk, and executing your trading plan consistently. If you found this update helpful, please like the video, share it with other traders who may benefit, and subscribe to the channel so you don't miss future market updates and trading insights. I'm Ifti from CLiK Trading Education. Thanks for watching, stay disciplined in the markets, and I'll see you in the next update.